Thanks for clicking. The risk of a wave of forced home sales in Canada is rising. This according to a new report coming from Capital Economics. The widely publicized report relies on data coming from Stats Canada, focusing on the increased use of alternative mortgage lenders when borrowers go to refinance their mortgage.
25% interest compounded monthly.
And while the recent drop in bond yields have led to some moderate decreases in 5-year fixed rates, the moves towards alternative lending, as reported by Stats Canada, is definitely concerning news. So what I want to do today is go over the report from Capital Economics as well as the data coming from Stats Canada, discuss some implications for Canada's real estate market, and then go over what to look for next. Speaking of next, we are eagerly awaiting the release of October's real estate data coming from the CREA, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. The widely publicized report coming from Capital Economics warns that there are growing signs that heavily leveraged, heavily indebted borrowers are struggling to refinance their homes with traditional lenders. As such, an increasingly large number of borrowers are turning to alternative lenders, turning to that alternative space to refinance their mortgage. The data released from Stats Canada showed that there were 4,000 insured mortgages refinancing with alternative lenders in the second quarter of this year. This is a more than 500% increase in the number going with alternative lenders than the same period of last year.
We're all fine, everyone's fine.
In fact, since the second quarter of 2022, we've seen continual increases in the number of borrowers refinancing their insured mortgages at alternative lenders in the alternative space. And while an increase in the use of non-bank alternative lenders is concerning, a closer look at what is actually going on is particularly worrisome. First, let's be clear. Refinancing isn't just simply moving your mortgage to a different lender. Rather, it's revising and replacing the terms of an existing mortgage. So, for our purposes, refinancing is when borrowers extend their amortization or take money out of their home. So, if you took out a mortgage in 2018 on a 25-year amortization, it comes up for renewal, and you want to extend that mortgage up to 30 years, that's refinancing. Alternatively, if you take money out of your home on the date of renewal, that's also refinancing. So, these increases in non-bank alternative refinancing are borrowers who once had an insured mortgage with an A lender and are now refinancing out of that mortgage to an alternative lender with the higher rates and fees that accompany it. And, says the report, the increase in the number of borrowers moving into that alternative space is particularly concerning given that, all things being equal, these borrowers should be in particularly good shape, having 5 years of paying down a 3.5% mortgage and the values of their homes rising by 40%. However, these borrowers moving to that alternative space says that these borrowers are having difficulty refinancing at their current lender, not being able to pass the stress test. Which makes sense. Back in 2018, borrowers had to pass the stress test of 5.14 or 2 points above the contract rate. So their stress test was about 5.5%. Fast forward to right now when borrowers want to refinance, and a decent 5-year fixed rate is 6.49, borrowers are having to qualify at 8.49%, which is a big difference in qualification. So we have a wave of borrowers wanting to refinance, take money out of their home, or extend their amortization, which I suspect is more likely as it brings with it lower payments, and they're not able to do so in the A lending space, having to move to the alternative side instead. So, to the usual suspects, the data is right there. Borrowers can't just extend their mortgages back up to 30 years without re-qualifying. Borrowers aren't paying 7 and 8% rates because they like them. Stop telling people they can just extend their loans. It's not that simple.
They need to go to a real school.
And the problem, says Capital Economics, could continue to get worse if home prices continue to decline. The report notes that a large portion of borrowers took out 1 and 2 year terms starting in 2022, in the hopes that rates would go up and be back down by 2024. And that may have made sense back in 2022. According to the Bank of Canada's Market Participants Survey, the same one that is currently predicting rate cuts by early 2024 and being cited by everyone in the real estate industry, in the fourth quarter of 2022 was predicting a 3.5% policy rate by early 2024. But those rate cuts predicted by those same participants in 2022 obviously didn't happen, with the policy rate rising to 5%.
They need to go to a real school.
Now, those borrowers who took out those 2 year terms in 2022 are up for renewal in 2024 and have seen their values fall and are probably now in a position of negative equity. Or, at best, they're well above the 80% threshold, meaning alternative lending won't be an option for those borrowers, as alternative lenders, all things being equal, require 20% equity. As such, with those borrowers not even having an option of moving into the alternative lending space, Capital Economics says that the risk of forced sales is rising. And to that, I would add the option of anticipatory selling. Homeowners selling their homes before it becomes a problem, before they get to renewal and are forced or unable to go into that alternative lending space. As we've talked about before on this channel, we've been seeing a massive surge in the number of new listings coming to the market. Yet, very few, except the usual delusional, think that the market is hot right now. Those listings aren't coming to the market because sellers think they can get top dollar, especially in November. So, according to Capital Economics and Stats Canada, more and more borrowers are having to turn to the non-bank alternative lending space to refinance their mortgage, to take money out or extend their amortization, which I suspect is the case. However, many of these borrowers are those that took out their mortgages in 2018 and took out a 5-year fixed. As time goes on, as we start to see more and more renewals at higher and higher interest rates, we could see alternative lending become less and less of an option, which would lead to more and more listings coming to the market, more and more forced sales, and, I would think, anticipatory sales as well. With that said, as we discussed, mortgage rates are coming down, though marginally. Whether or not that will be enough to help with those mortgage renewals and keep those listings off the market remains to be seen. But we will continue to track Canada's real estate market on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.